In this video we are going to talk about dividend stocks with high growth. So before starting, please like this video and subscribe to this channel for our future updates. The stock market can be quite volatile in the near term. Stocks, on the other hand, clearly outperform other financial assets such as bonds and cash over the long run. In a low interest rate environment, this is especially true. It's difficult for government bonds and bank savings accounts to deliver acceptable returns or cover a person's retirement demands when interest rates are so low. As a result, investors are turning to dividend stocks to make up for the income shortfall. Conditions are rapidly shifting, with interest rates set to rise amid a surge in inflation. Some traditionally dependable dividend stocks are failing, while new leaders in industries like real estate have arisen. For the rest of 2022, here are 8 of the finest dividend stocks to purchase. Number 8. Suncor Energy Incorporated, SU. When seeking dividends, energy stocks are frequently a good place to start. This is especially true at this time, when the price of oil has risen to levels not seen since the beginning of 2014. At the moment, the ongoing geopolitical uncertainty in Eastern Europe is providing additional support to the price of energy items, which are already rising. The fact that huge, low-cost oil producers are finding safety in this tumultuous market is a welcome development. Suncor, for example, is the country's largest integrated energy corporation by market capitalization. Aspects of the company's crown jewels are its low-cost oil sands projects, which are mostly located in the Canadian province of Alberta. These assets have long service lives, often spanning decades, and, as a result, they provide a stable and dependable energy supply. As the price of oil has risen, Suncor has been able to rebuild its balance sheet, while also increasing its dividend payout. The stock is currently yielding 4.6% and trading for less than 9 times projected earnings in the current quarter. Number 7. Gilead Sciences Incorporated, Gilead. Gilead Sciences, a biotech behemoth, has seen its stock price fall by around 15% since the beginning of 2022. As a result of this decline, Gilead is on the verge of reaching its lowest share price since 2013. Investors in pharmaceutical stocks should keep Gilead stock on their radar screens, as the firm is once again trading at less than 10 times forecast profits. One of the most serious problems facing Gilead is that its flagship hepatitis C business has seen sales decline since a large proportion of the patient population has been successfully treated for the condition. It has taken Gilead years to develop and buy other treatments to compensate for the reductions in sales, and it will take even longer to increase the company's revenue stream. Gilead has also been active in the COVID-19 therapeutics arena, and as a result, the company's stock has fallen in recent weeks as traders have lost interest in that particular theme. Analysts predict that the company will resume earnings growth in 2023, and in the meantime, the stock is now yielding a healthy 4.8% on its shares. Number 6. VF Corporation, VFC. VF Corporation is a clothing and footwear corporation that is best known for its brands, Vans, The North Face, and Timberland, among others. An aristocratic dividend payer, the company has increased its dividend for more than 25 consecutive years, earning it the distinction of being a dividend aristocrat. That's quite a feat for a company operating in a cyclical and fast-moving market like the garment industry. Due to the fact that it gets its brands on the cheap and then transforms them while under its control, VF Corporation has been able to pull it off. For example, it purchased both Vans and The North Face for pennies on the dollar when compared to what they are currently valued at in today's market. VF Corporation, like many other businesses, is currently experiencing difficulties with inflation and its supply chain. However, this has been more than reflected in the stock price, which has fallen by more than 20% in the last 6 months. As a result, the share's dividend yield has risen to 3.4%. Number 5. First American Financial Corporation, FAF. First American Financial is the second largest title insurance firm in the United States. This is a necessary service that most homeowners in the United States must pay in order to obtain a mortgage. The fortunes of First American are strongly related to the fortunes of the property market. Because of the large number of rate hikes that are expected, investors are selling off a large number of companies that are associated with the housing market. However, in the case of First American, it is possible that this is a mistake. The stock is priced at only 6 times trailing earnings right now. Even if one assumes a dramatic fall in housing market activity in the foreseeable future, the company is still trading at a mere 9 times expected 2022 earnings per share. Aside from that, the firm's expanding real estate software and digital services division helps to mitigate any potential weaknesses in the company's main title insurance business. And now, as a result of the recent decrease in the market price, shares are yielding an additional 3.1%. Number 4. Prudential Financial Inc, PRU. Another industry benefiting from rising interest rates is insurance. Prudential Financial may finally be ready to break out after years of sluggish trading. One of the major beneficiaries of interest rate hikes should be the life insurance industry. Customers' policy premiums are invested in financial assets, which is how insurance firms gain money. Due to historically low interest rates, the bond side of that combination has produced disappointing returns in recent years. Bonds have generated less interest than a historical model would have predicted, reducing profitability. However, when interest rates rise, Prudential should be able to earn a more acceptable margin on its investments. At the moment, shares are trading at barely 0.7 times book value, as investors remain pessimistic about the future. Prudential shares are now available for purchase at a dividend yield of 4.3% and a price-to-earnings ratio of less than 9 times forward earnings. Number 3. Citigroup Incorporated, C. Some market experts said it was too late to buy the main American banks in 2022. After all, banks have already made up for their epidemic losses, and the market has been pricing in rate increases for months. The trade may have appeared to be over, but some of the banks have fallen significantly from their highs. Citigroup, for example, has dropped from $80 last summer to around $64 as of February 22, placing the company back into the value category. Both the trailing and prospective earnings are valued at less than 8 times. Citigroup is also trading at just 0.7 times book value, which is an exceptional bargain for such a big global banking company. Because of the recent price drop, the dividend yield has risen to 3.2%, making it one of the best dividend companies to buy right now. Number 2. Clorox Company, CLX. Clorox is another consumer staples business with a high dividend yield that is currently on the decline. During the epidemic, the company saw a boost in sales as the demand for cleaning supplies skyrocketed. However, sales have plateaued since then. Meanwhile, Clorox has been hit by inflation, as it has had to pay more for raw materials, labor, and transportation. When you add it all together, Clorox's profits are currently substantially below pre-pandemic levels, and the stock price has declined precipitously in response. However, this blue-chip stock sentiment may be overly pessimistic. Clorox should be able to stabilize its earnings over the next year or two as pricing increases take effect. Meanwhile, once the company has moved past the epidemic phase of higher sales volume, earnings comparisons will be substantially better. For the time being, Clorox shares pay a 3.1% dividend, which is exceptionally high for the company. Number 1. Unilever plc, ticker, UL. Unilever is a consumer goods multinational headquartered in the United Kingdom. Soap, vitamins, pet food, personal care, coffee, tea, cereal, and a variety of other products are among the company's offerings. From its collection of more than 400 brands, this premium dividend stock earns nearly $60 billion in revenue each year. Unilever has battled with a lack of organic growth and profit margin pressure in recent years. Activists, on the other hand, have taken a keen interest in the corporation and are attempting to shake things up. Meanwhile, Unilever's operating results could improve as price increases assist the corporation in responding to the current inflation wave. For the time being, shares trade at about 20 times earnings and pay a 3.8% dividend. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.